Hi, good morning, everybody. Thank you and welcome to our morning webinar. So today we'll be covering some topics on the Singapore market and some stocks. Today's agenda will cover firstly the Singapore REIT sector, secondly the Yoma Strategic Holdings stock initiation, and lastly we'll finish off with the Phillip Singapore Weekly macro update.
Okay, hi, I'll be continuing on Yoma then. We'll be initiating on Yoma today with a buy call and a target price of 46 cents. A bit more about Yoma next slide. Yoma is a leading conglomerate in Myanmar with businesses across real estate, consumer, automotive and heavy equipment, as well as financial services and investments. We like that Yoma is entrenched in Myanmar's fast-growing and attractive consumer segment. It has a large property land bank equivalent to 10 to 15 years of sale. Financial services are also poised for growth on the back of a 5 times revenue lead in wave money. Its growth in the F&B segment is also underpinned by a 60% growth in KFC over the next 3 years. We find current valuations depressed in view of structural growth. Key risks for the counter will include a greater slowdown of Myanmar's economy, supply-side constraints, a restrictive business environment, and forex risk. As mentioned, Yoma generates its revenue through 4 key business lines, namely property, F&B, motors, and financial services. Land has historically been the biggest contributor to Yoma's top line. However, as Yoma moves towards opening more F&B stores and growing with money, we are expecting a shift in portfolio mix towards these growth segments. Yoma Land is a leading property developer in the country, boasting one of Myanmar's largest land bank at 9.3 million square feet. Yoma Land is transforming Yangon's cityscape across 3 flagship developments, namely Star City, Yoma Central, and the Peninsula Yangon and Punhiang Estate. We like that Yoma Land has a huge land bank equivalent to 10 to 15 years of sale, and we are expecting the growth of the middle class to benefit sales of City Loft at Star City, which is actually their maiden entry into the mass market segment. There is also approximately 8 months worth of unrecognized revenue from City Loft, which will help to support FY20's top line. Lastly, Yoma Central will be completed in 2021, hence we are expecting the retail and commercial leasing to contribute to Yoma Land's recurring revenue. The key risk that we identified for this segment is the delay in construction to impede revenue recognition for land development, and slower leasing activity in the near term to impact the rental income from investment properties. Next, Yoma Financial Services comprises of 2 business lines, namely Yoma Fleet and Wave Money. Yoma Fleet is one of the country's largest vehicle leasing and rental operators, while Wave Money is Myanmar's leading provider of mobile financial services that is licensed to provide mobile money services like money transfers. For Yoma Fleet, we see continued growth in fleet size and better margins to improve top and bottom line. As of March this year, the fleet size increased by 9.5% year-on-year, and its total AUM grew by 34.3%. The shift in portfolio mix towards the finance lease products also resulted in better gross profit margins. For Wave Money, we see growth in a couple of reasons. Just to be a background, Wave is the first licensed mobile financial services operator in Myanmar. It has 2 main businesses, over-the-counter, OTC, and e-wallet via WavePay. Within 2 years of inception, Wave Money became profitable, with revenue up by 5 times year-on-year and 16% quarter-on-quarter. Money transfer volume tripled year-on-year to 4.3 billion in 2019, which is equivalent to 6% of Myanmar's GDP. This is largely attributable to its brand leadership and large network of Wave agents. Sorry, Siti, do you mind going back 2 slides? Yeah. So covering 93% of the country, Wave's network consists of 57,000 agents, making it more than 20 times larger than that of the traditional bank branches. Like banks, consumers just need to visit one of Wave's agents, be it like a local grocery or pharmacy like what's shown in the picture, to execute a money transfer transaction. However, unlike banks that are charging like 5 to 10%, Wave is offering transaction charges of 1 to 1.5%, which is 3 to 6 times cheaper. This links to investors looking for a reliable, accessible yet affordable option. Okay, so other growth drivers for Wave include the adoption of e-wallet business to accelerate past that of the OTC business, as Wave continues to integrate more merchants into its platform. M Financial, aka Alipay, plans to invest $73 million into Wave for a 33% stake, which highlights its confidence in Wave's business model. With this partnership, Wave can tap into Alipay's experience to better serve the underbanked individuals and SMEs in Myanmar. Lastly, amidst COVID, the Central Bank of Myanmar promotes the use of mobile money over face-to-face transactions by increasing the daily limit from 500 kyat, which is around $500 Sing, to $1,000 Sing. This is favorable for Wave in terms of transaction volume and ticket size, as Wave embarks on more governmental and B2B projects like helping banks and microfinance companies disperse pensions as well as collect loans, we are confident that Wave still has lots of room for growth. Yoma F&B owns the largest F&B platform in Myanmar. It comprises of 3 segments: restaurants, bottling, and logistics. I think most of the business units here are quite self-explanatory except for YKKO. So YKKO is actually one of the largest restaurant chains in Myanmar, which Yoma acquired last year, selling kueh o, a popular noodle-based dish in Myanmar. We like that the restaurants remain resilient amidst COVID. Restaurants revenue almost doubled year-on-year in March this year, attributable to new contribution from YKKO, as well as new net store openings at KFC. Additionally, improved margins were generated through KFC's and YKKO's higher gross profit margin. Should Myanmar's economy improve, the restaurant segment is expected to grow with Myanmar's growing middle class. Yoma F&B's growth is underpinned by at least 60% growth in KFC stores over the next 3 years, from the current 45 to 75 stores. Lastly, we envision more cost synergies from the logistics and restaurant business. Metro Myanmar, a leading specialist in food, wholesale, and retail, offers customers a virtual one-stop shop solution that combines online trading with delivery services, which are made by cost-plus fleet of trucks. This end-to-end distribution and logistics platform will be able to complement Yoma F&B's restaurant businesses. Keys to the segments include weakness in the bottling segment, as well as competition in the wholesale and retail arena. Okay, so for the last segment, Yoma Motors comprises of 2 main segments, namely heavy equipment and passenger and commercial vehicles, PCV for short. Scalability and profitability of the PCV segment is expected to support Yoma Motors' top and bottom line. The overall margin improved in March this year due to better margins from PCV. Despite lower sales from the heavy equipment segment, its scalability resulted in a 5 times increase in revenue year-on-year, which pushed Yoma Motors closer to break-even. We are expecting demand for PCV to increase, underpinned by low vehicle penetration at 1 unit per 100 people and government policies to help raise the number of cars on the road. Lastly, under the National Transport Master Plan, the Myanmar government is planning to allocate $21 billion to railroad, port, and aviation projects by 2030. Several large-scale infrastructure projects like the construction of the India-Myanmar-Thailand Trilateral Highway are actually underway, which will create a healthy demand for construction equipment. As Myanmar continues to urbanize, we believe that both construction equipment and PCV segment will remain a pillar of support for Yoma Motors. Keys to this segment include vehicle sales from the New Holland tractors amidst drop in agricultural demand and potential weather conditions. In terms of its strategic investor, Ayala Corporation, Ayala is the oldest and one of the largest conglomerates in Philippines with core interests in real estate, banking, telecom, and power. In November last year, it invested $155 million for a 20% stake in Yoma, making it the second largest shareholder. Testament of his confidence in Yoma, Ayala paid an issue price of 45 cents per share, which represents a 36% premium over its VWAP on 12 and 13 November last year. We are anticipating significant collaboration between the 2 power players, which will help strengthen Yoma's foundation for future growth. In terms of outlook, we see near-term headwinds for Myanmar's economy, as it is heavily impacted in the face of trade and tourism. GDP is expected to fall to 2 to 3% from the projected 6.4%. However, we are expecting a gradual recovery in the range of 4 to 6% with improved business sentiment, better access to electricity, and improved availability of credit. Myanmar continues to work closely with its neighboring countries like China, Singapore, and Thailand to discuss about future FDI opportunities. This to Myanmar's economy will include the following. Slowing global and regional growth, especially in China, can transmit to Myanmar through trade by lower external demand and FDI. Also, growth in the private sector is hindered by supply-side constraints like access to factors of production, both physical and digital connectivity, as well as a restrictive business environment. Lastly, the Myanmar kyat could weaken in the coming quarters as a result of renewed trade tensions between the US and China. The upcoming 2020 general elections could also add another source of uncertainty. Lastly, we initiate coverage on Yoma with a buy and an SOTP derived target price of 46 cents. In our model, property and financial services constitute 73% and 70% of its assets, respectively. Downside risk to our valuation includes the depreciation of USD and a conglomerate discount of 20% has been applied. That's all from me. I'll be moving on to Natalie or Paul.
Okay, hi. So In this kind of the next page, in this month's Read Monthly, I'll go through the investment thesis for the S-REITs, covering 5 reasons why we believe that there will be a re-rating for the S-REITs. So on the next slide, jumping in straight to the first reason, we believe that the acceptance of higher gearing levels will benefit the REITs. So amongst the REIT markets, as you can see from the chart on the right, Singapore and Hong Kong have the lowest leverage limits of 45%, then followed by Malaysia and Thailand of 50 and 60%. And the other developed REIT markets, such as Australia, Japan, US, and France, they have no leverage limits. So to help REITs prevent accidental breaches of leverage limit due to the market forces beyond the REIT manager's control, such as deterioration of asset values, and to provide flexibility for REITs to draw upon debt facilities to meet cash flow mismatch, the Monetary Authority of Singapore, MAS, raised the leverage limits to 50%, deferring the 2.5 times interest coverage prerequisite until January of 2022. So while we do expect S-REITs to gradually utilize the higher gearing headroom, the market turbulence induced by COVID-19 forced S-REITs and investors to confront and get comfortable with the possibility of higher gearings. We believe that this paves the way for a REIT market that is more receptive to higher leverage ratios, which in the long run allows S-REITs to be able to move more swiftly when competing with private funds and other REITs for assets, and allow S-REITs the flexibility to optimize their capital structures. We also believe that COVID-19 is only an accelerator of the technology-enabled structural shifts, and it provides opportunities to make portfolios more future-ready. Pre-existing risk for the commercial and retail segment are the right sizing of space by tenants, be it to become more efficient with their space requirements or averaging down the cost of space through the hub and spoke strategy, or e-commerce, which has been a growing threat over the years. So as part of active management, landlords have been exploring various methods to pad the demand as well as increase tenant stickiness. New demand from flex space operators have helped to soak up some of the supply in recent years, and we have seen developers take stakes in co-working operators to get a better understanding of the operation and sustainability of this trend. Retail landlords have embarked on reward programs to drive tenant and customer stickiness, embracing e-commerce trends through the promotion of an omni-channel model and experiment with these structures with higher risk sharing. So for the office sector, this post-COVID-19, we actually think that this actually provides a stronger use case or another use case for flex space. And the outlook for flex space is optimistic as an intermediate stage in a change of occupier strategy, as well as a scalable solution for new businesses entering the market. And for the retail sector, we think that we see two kind of catalysts for the retail sector. First of all, retail landlords using e-commerce to future-proof their traditional retail. So one example is CapitaLand. They recently, on May the 22nd, launched e-commerce platform, which is called eCapital Mall, and an online food ordering platform called Capital Treats, which are available through CapitaLand's Capital Star app, which is the rewards loyalty program, as well as the mall website. So this move towards digitalization and omni-channel actually helps to future-proof the CapitaLand Mall offering, and it actually positions them stronger and builds an ecosystem to drive customer and tenant stickiness. Yeah, it will not only help during this period of depressed sales, but also position CapitaLand branded malls for the future. The second silver lining is the move towards risk sharing. So while we expect that some retailers vacancy rates to go up because some retailers might go under, the shift towards more risk sharing might actually create more demand for retail space, as it makes it more economically viable for new to market brands to enter or rather get a brick and mortar presence. So moving on to the third reason. So REITs have been tried and tested, and we believe that the S-REITs remain an attractive yield play and testament to their leasing strategies and portfolio attributes that REITs have embedded in their portfolios. REITs have implemented leasing strategies and portfolio attributes that will help to maintain stable distributions, and this includes long WALEs, well-distributed leases and debt expiries, balance of stable and growth leases, and prudent interest and effects management strategies. So the DPUs for most REITs are expected to be lower in FY20. However, this is largely due to rental rebates granted to tenants during these unprecedented times. So barring such extreme events, and in spite of the structural shifts that will unravel in the following years, we believe REITs that have incorporated sufficient stabilizing attributes will continue to provide stable distributions. So the postponement of some government land sales, as well as landlords exploring redevelopment and change in use, we believe that supply will adjust to help the real estate sector achieve a healthy equilibrium. And while leasing activity is expected to be softer in the near term, construction slippages and higher renewals due to companies delaying expansion and relocation plans will provide some near-term support. We believe that the current prices present a better entry price. The dividend yield spread is currently at the 0.24 standard deviation level, and this compares to the whole of 2018, where the yield spread was actually -1 to negative almost 2 standard deviation. So this presents a very attractive entry into a long-term dividend yield play kind of investment. With recovery in the REIT sector underway, the dividend yield spread is actually currently now about 4.5%. It matches the yield spread of the average yield spread in 2019. The dividend yield spread is actually more attractive at 3.4% due to the lower interest rate environment that we see currently. And this is about almost 100 basis points higher than the average of 2019. So the recovery in prices and the low interest rate environment presents a conducive environment for acquisition. In the next slide, you will see that the recovery in share prices. So with this recovery in share prices, acquisitions will start to look more accretive. And as we know, REITs usually finance their acquisitions using a mix of debt and equity. So now with the recovery in share prices, acquisitions are starting to look more possible and accretive. So not to mention, well-capitalized REITs will seize the opportunity to pick up distressed assets at attractive valuations. On the next slide, you'll see that historically, REITs have exhibited an inverse relationship with interest rates, with periods of declining interest rates leading to strong price appreciation for the REITs, the figure on the left, and the outperformance of the REIT index against the STIs during these lower interest rate periods, defined by the shaded areas on the right. So we'll dive into the subsector performance. On the next slide, you'll see the retail sector. So as you can see, this is the RSI excluding motor vehicles for the month of April. It was weighed down by the discretionary trade. So that will be your fashion, these kind of trades, jewelry, etc. The only positives were the fast-moving consumer goods segments, the supermarkets, and the mini-mart and convenience stores. Within the F&B index, which was also negative by about 53%, the fast food outlet segment fell the least, almost 30%, compared to the restaurants, caterers, and food outlets. So entering phase 2 is a positive for the retail malls. All trade segments are expected to benefit, with fashion sales being lackluster due to lack of purchasing triggers. For the hospitality sector, this is also April's figures. You can see that hotel international visitor arrival fell by almost 100%, registering only 748 international arrivals in the month of April. Hotel RevPAR also down by about 80% year on year in April, and average occupancy is only at 41%. We noticed that the accommodations with lower price points, so your economy and your mid-tier, were less affected in terms of decline in RevPAR compared to your luxury kind of accommodations. The fast lane agreement or the green lane agreement between Singapore and China, and in future other of our trade partners for essential trade will help to bring occupancy up, although very, very slowly, as the lingering fears and caution, even after international travel bans are lifted, may keep visitors away. So in the near term or short term, we expect domestic demand to actually supplement occupancies. So that's all for me. Passing it back to Paul for the Phillip Weekly.
Okay, thanks, Natalie. Next slide. This is our usual weekly. Actually, it's actually bi-weekly. But anyway, we just give you some of the key macro data that's out. So we start with Singapore. Like Natalie mentioned, so these are the tourist arrivals in April. I think you don't have to rub your eyes. There was actually really only 748 arrivals into Singapore in April. This compares to 1.6 million visitor arrivals. Obviously, the importance of this number obviously is impact on hotels, but the other part will be on the telcos. As we mentioned before, about maybe 10% or to 15% of the revenue comes from roaming. roaming, which is inbound, that means tourists coming in, and also outbound, that means Singaporeans going overseas for business or leisure. So that this number is significant because it also means that there's virtually a disappearance of this roaming revenue for the telcos, and they will be impacted because there's no arrivals coming in or leaving. Move on to the next. This is just some data that we got on the land transport. So this is SBS ridership, northeast line. So of course the number of ridership came down almost 85%. So that's a negative. In terms of the taxi business, I guess this is for comfort. The number of taxis declined almost 1,000. This is a record decline in May to 16,000. Rental cars also dropped. As you can see from here, the second line, rental cars dropped 976 to 75,000. But what we monitor more is the ratio. We'll show you a chart later. So the competition is actually intensified for taxis. A year ago, there used to be like 3.6 private cars to one taxi. So, like we always say, one taxi there, then you can see 3.6. But now the ratio has jumped to 4.6. So the competition is, on paper at least, has intensified for the taxi drivers. Okay, I'll move on to the next macro data. Of course, the big news, one of the big news in the US was at least retail sales. It's still down actually 6.6, but actually what everyone was rejoicing about, there's a big rebound. I think the largest rebound month on month, that means from April to May of 12%. So this is the highest on record. But of course, the prior month, they actually fell also the highest. So I mean, everyone is just rejoicing there is a recovery, or at least on paper, a V-shaped rebound in consumer spending. Later, we'll show you a chart later, but just on the Sembcorp Marine and REITs and Sembcorp Industries demerger, I think it's quite pretty obvious, I guess, if you do own Sembcorp Marine, it's better to switch it to Sembcorp Industries. I mean, provided you actually own, anybody wants to own Sembcorp Marine. Okay, but we'll show you a chart later. In terms of our tactical views, there's obviously, we've seen the lows in economic activity, and also we've already seen the lows beating of the market. From this point onwards, the upside will be gradual as the economy reopens and recovers. But for us, a slow recovery has its merits, because what it does happen is that it will lead to very, very loose monetary conditions, as we especially seen in the US, and of course fiscal support as we haven't seen here locally. So a gradual recovery isn't so bad, because actually it keeps interest rate at a very depressed levels, and as we've seen from the dot plots from the Fed, they've already said that they have not even thought about this is not my words, so this is their words. They have not even thought about thinking of raising rates. So you probably expect very low rates for the next 2 years. So as a result, in terms of sector-wise, we just like we overrate REITs and even electronics, which we think is also should be beginning to get some recovery. Of course, what can derail anything that we see now will be the second wave of infections. But again, the difference right now is socially, and also, but the governments they've responded, and they actually understand the situation and can manage it, or at least manage it much better than in the past. So anyway, we move on. In terms of the events ahead, of course, today will be the Escort inclusion into NAREIT, and also Mapletree Industrial replacing SPH on the STI. Of course, the price probably all moved on Friday as they did their rebalancing. Then, of course, we got some macro. And, of course, these are some of the events that we are holding. After this, of course, Monday, we always have our market technicals, which is very, very popular. And, of course, we also have our credit outlook. If you just do, anyway, all these events are in our poem. So do sign up if you're interested. And we will have our usual Singapore strategy on the 4th of July. Luckily, it's not only me. So it's actually, you will involve other countries, Hong Kong, Malaysia. So if you're not interested in Singapore, at least you can see Malaysia and also Hong Kong if you want to listen in. It will be on the 4th of July. And we got our usual event on Tasin. Move on to the next. Okay, nothing much. This is just to show you the collapse in real ridership. Not that everyone doesn't know, but just to reflect, just to show you on the chart that real ridership actually affects. Okay, the only thing to add is that rail will affect comfort because they do rely on ridership. But bus traffic doesn't really affect them because, like I said, they are paid on the mileage or travel regardless of passenger. So the chart on the right is actually the taxi. So taxis is the blue line. As you can see, it's already peaked and continues to drop. And we saw a steep drop in April. And also you can see the rental cars. But what we monitor usually is the green line, which is how competitive it is for a taxi. So it used to be 1 for 1, then 2, then 3, then now of course it's 4.6 that we mentioned earlier. Next slide. Okay. Again, we always monitor this. We're gonna keep on monitoring on this until for many more months. This is again the daily cases. This is a WHO number. So obviously globally, you can see the number of new cases globally actually has not peaked. You saw the big spike across the 160,000. I think this is 180, if I'm not mistaken, of new thousand of new cases. Of course, Brazil is one of the culprits. But what is more important, I guess, right now would be the large economies, the US, China. So those is still are still trending down. It's not trending down very sharply, but again, it's off the. You can see the red line. It used to peak maybe 60,000, then now it's probably about 20, 30,000. But at least it's like even in Italy, they've opened up. The cases are still dwindling down. It's not like a big resurgence. Nothing much. I think this one just the retail sales, how it dropped, and of course the difference is you can see from the recession is that this time the rebound will be much steeper. I think in the US, we're actually having a similar, which we already know there's a recession in the US. So, and the retail sales reflects this. But this time around, we probably get a much sharper recovery, unlike in the 2009 global financial crisis, where it took a few months before you can see it recovering. Okay, this is just electronics. Just that electronics, when we monitor, there are lots of data to monitor, but it seems to be quite resilient, especially semiconductors. As you can see on the two charts on the right, it's still holding up. It's not like robust. You're not going to see like the 60, not like the global semiconductor spending 60%, but it is still hovering around low single digit. And even the exports, the chart at the bottom, it's still holding up well considering the environment and the shutdown and the lockdowns. Of course, the one that we hope to see better numbers is the top left, which is Malaysian electronic exports. I think this is not due to demand. We think this is because Malaysia had the mandatory, had the movement control order, the MCO. So as a result, a lot of factories couldn't open in the beginning. So I think right now this should resume, and we should expect to see a rebound in electronic exports. Okay, this one's a bit confusing. So let me just guide you through. This is the whole demerger. It's confusing because the whole structure is also confusing. So any first part, the table on the top is actually SMM means Sembcorp Marine. So as you know, Sembcorp Marine is doing a rights issue. So that's part one. That's why we think there's two share overhang for Sembcorp Marine. So part one, there's a rights issue. So you can see the existing number of shares in Sembcorp Marine is 2092.7. So right now we have number. So there's going to be a 5 for 1. So for every one share, congratulations, you're not going to get 5 shares, but you have to pay 20 cents. So now the number of shares will jump from 2 billion to 12.556 billion. So what will happen is that, as you can see from the first bullet point on the right, the third price, that means once it goes X, that means once the rights issue is over, based on today's, this was Friday's price, the share price will drop to 25 cents. So we think there will be one overhang, and there'll be people looking to sell, because if you own 1,000 shares or one lot of SMM now, it's worth $500. Then you have to fork up double the amount. You have to invest another 1,000 to subscribe to the rights issue. Otherwise, your share price is just going to drop back to 25 cents. That's the third price. So that's the number one. That's the first overhang, which we call the part one rights issue. Okay, then the second part is SCI, Sembcorp Industries will demerge. So if you look at the part, the SCI, they used to own 1274.3 shares or 60.9% stake. So they are saying, okay, I don't want Sembcorp Marine shares anymore. You can take it back. Temasek can take it back. Thank you very much. So, okay, but the problem is, Temasek won't sell, but the problem is that 3877.4. So post the merger, that means all the Sembcorp Industries shareholders will get Sembcorp Marine shares. The ratio is about 4.27. So what will happen is that we worry that this will be another overhang. Firstly, I don't think they actually want Sembcorp, maybe indirectly, but they've been in a way kind of stuffed with Sembcorp Marine shares. So this we worry will be another batch of shares that could be out there looking to sell. This 3.887, because so you're a Sembcorp Industries shareholder, then tomorrow you suddenly get Sembcorp Marine shares. So what's your first thing you think is that if I don't sell, the next guy, my neighbor, is going to sell, so I better sell. So we just worry there's going to be a bit of an overhang on that, and this a big overhang is about 30.9% of worth of shares. So that's why we worry that Sembcorp Marine, there could be two major selling. Of course, you get some rights entitlement, but again, it also depends on how people value these rights, and everyone also will be looking to sell up their rights entitlement. So for us, the other way, if you really still for some reason want to own yachts, so the better way is to actually own it through Sembcorp Industries. So this is the reason why. So if you look at part 3, so now you're a Sembcorp Industries shareholder. Sorry, it's very long-winded and very complicated, so I apologize for that. But that's how, because it's hard to explain it any other way. So right now you're a Semco industry share. So you will get, once this whole deal demerges over, you will get 4.27 shares. So that 4.27 of SMM shares at 25 cents is about 107. So so you take 107 minus the Semco industry share price of 192. So you're valuing Semco industry shares about 0.85, which is quite cheap in the sense that it's only 0.5 times price to book, price to NTA. You can see the last bullet point, the implied valuation. So what I'm trying to say that if you really want to own Semco Industries, it's better to just own it through Semco Industries. If you still want to own, I mean, so it's better to just switch it out, and you don't even have to fork out the additional money, because Semco Industries has already subscribed to it, and you don't have to come up with any single cent. So sorry, it's very complicated, and if you have questions, you can ask me. But that, because the whole structure is a bit complicated. Anyway, this is just a rough summary of the impact on phase 2. It doesn't really impact, like, okay, let's say the first one, like Genting Singapore, the theme park is still closed. I think some have actually asked, should Genting be a better way to play this recovery? Okay, the worry we have is the second part, which is the air travel. So according, as you know, there are green lanes now, but the green lanes is not meant for mass market travel. I think the minister already said. So without mass market travel into Singapore, Genting Singapore will still suffer, because they still have to rely on domestic. I'm not sure how many people want to go to, a casino is okay, but in terms of the theme park, I'm not sure how much visitors they can absorb with just the relying on the domestic market. So that's why the travel will still be slow. The green lanes is also, if you want, there's a good YouTube there. You can just go link it there and watch. Actually, you have to do tests in China, then come to Singapore, you still have to do tests. And that's why it's very cumbersome, and it will probably be only for business travelers. The rest, I think you can read in terms of retail and the impact on the rest. Like the reopening of the malls, of course, will be the most positive. It will take some time, but it'll be most positive. And probably one thing to add will be, probably those Orchard-related malls that rely on tourism will be the more affected than the suburban malls. Okay, anyway, this is my last slide. This is just to give you a sense that the worst is, at least for Singapore, the worst is slightly over in terms of the lockdowns. Of course, we had the circuit breaker, then phase 1, phase 2. I think the one thing to note is the red line, the chart on the table on the right. So this is the 7 weeks, the moving average 7 weeks of community and imported cases. So as you can see, the reason why we did the circuit breaker, it shot up to almost 60 a day. You can see the red line just before the first beige shaded area. So it went up to as high as 60. That's why we had to do this circuit breaker. But then you can see after post-circuit breaker, the number of community cases actually dwindled down. As you can see on the table on the left, just before phase 1, when we moved out of circuit breaker, we had only about 4 cases a day. Right now also it's about 4. Apart from yesterday, it was a bit high. I think yesterday it was 10. But anyway, I think so long as we go below, I'm just a guess, so long as it's below 20, that red line, the moving average, the weekly, that means the average for the past 7 days, does not cost 20. I think we more or less, we could see the phase 2 start to lighten up and so forth. Obviously, this is important because it also means there'll be less stress on the banking sector, improvement in retail. So the whole overall economy doesn't have to reverse and go back to a lockdown. So this is probably the important number to monitor. So long as we don't have consistent new community or imported cases for the next, of maybe I'm just pulling a number above 20 and so forth. So that's why we think the market's probably off its lows and recovery is underway, but it will be gradual, I guess. Okay, I think that's it for me. If you have any questions, you can please send them over to under our Q&A box. Thank you for dialing in.
Hi, there's a question on the forward dividend yield for Yoma, and this is assuming that there'll be a dip in EPS due to COVID-19 and the trade war. So the company has actually adopted a dividend policy to provide shareholders with a dividend payout between 10 to 20% of its profit after tax attributable to shareholders as dividends. So in the near term, right, we're actually looking at a pretty an impact on the earnings. So for the next 2 years, we're actually not expecting any dividend yield. But then why we feel that the stock is attractive is because, like, in terms of its valuations, if you look at the SOTP valuation, that, sorry, do you mind moving back to my Yoma slide? Sorry. Yeah, this page. Thank you. Okay, so like if you look at this slide, right? In terms of asset valuations, if like property itself, as in like after all the calculations, we actually do see an upside, a capital upside of about 80%, 86%, from this counter, and therefore we actually feel that this stock is pretty undervalued, and this is actually why we are actually liking this stock.
Okay, because the next question is for me, I guess. SBS ridership of 195,000 versus 1.2 million, with a decline of 85%. Will this hit SBS transit revenue based on the new business contracting model? Okay, it won't. This is mainly on train, so it will hit their train, but it won't hit the bus. Because I think, like we mentioned before, bus is they get paid. Like sorry to repeat this again, but they will get paid even if the bus driver just drive in circles. Even if there's nobody in the bus, they just keep on driving in circles. They're still going. I'm just exaggerating a bit, but even if they just drive in circles, there is no visitors. I think they will be generally fine. That they will because they are based on the amount of on the amount the distance traveled, and so forth. And I think for one thing about public transportation, that's something that the authorities cannot less able to control, because you have to keep the capacity up. You cannot like cut down the public transport by 50% and so that you can contain safe distancing. It doesn't work that way. So sorry, just to answer it, yeah, it won't impact the bus contracting so much. Okay, the next one, has the resolutions of Sembcorp Industries or Sembcorp Marine been passed? What is the implication of SCI shares if the resolution not passed? I think that's a good question. Okay, firstly, SCI, okay, there are almost three parts to the resolution. Of course, on SCI, they just have to vote whether they want the deal. Of course, all the SCI shareholders will want it. I think they probably stand on the desk shouting they want this deal because they see the share price doing this way. If not, the share price will obviously drop because they got rid of, not say got rid, they removed a loss-making subsidiary. Okay, the tricky one is on SMM, Sembcorp Marine, because all this, Temasek cannot vote because Temasek is a related party. So there are two resolutions. Firstly, is the rights issue. And secondly, on the demerger, there's a whitewash waiver. That means otherwise Temasek technically has to give a general offer to all the SMA shares. So it's a bit, I can't, this I really don't know how the minority might vote. Because if they see the share price drop, but they may actually vote no for this because Temasek cannot vote in this particular deal. So you are right. I mean, there is a bit of a grey matter here. I'm not sure how they will vote because to them, if I vote, the share price really drop, and even if they vote no, the share price may not actually rise because Sembcorp Industries still need the money, they still need the liquidity. So it's a bit tricky for me but I just don't. It's not a real slam dunk thing that this deal can pass through. I mean, just in a nutshell, and I'm really not sure. So I can't really answer that. I'm so sorry. I'm not sure. Can't say 100% that the deal can actually go through. Because Sembcorp Industries shareholders will say, like, if I do this, why can't I just force Sembcorp Industries to convert their loan into shares? So it's not a complete. I can't give you a complete answer for that. Sorry. Next one is DBS in the uptrend at support level. I think this one we can ask Viren to answer. Likewise, any comments on CSC Global at the current price? I can wait for Viren for the technicals, but the only comment I can give, I don't really cover CSC, but I do listen. Just that some of the business is actually reliant on oil and gas, the drilling activity in the US. Obviously, production is coming down in the US. So again, how it impacts them, I'm not clear, but obviously indirectly it should be a bit negative if the oil and gas activity in the US comes down. But it's better to get it directly from the company. But I think Viren can help you on the technicals for this. Next, okay, another question. After SMM and Sembcorp Marine and Sembcorp Industries demerger, do you see any development on Capital Corp? I think if I'm a Capital Corp management, I see this deal. Obviously, I also want to do a similar SCI and get a pop in the share price, and probably just tell Temasek, hey, can you take this back? Thank you very much. So it's actually positive. I think you've seen how Sembcorp Industries share price reacted to this demerger. So I think it will be a positive, and if they can actually get Sem Marine to acquire it and merge it, and this, i.e. just get rid of it, I think you could see a similar, quite a good pop in the share price. So I'm sure the management after seeing this will also want to have a similar role and pass it back to someone else, you know who. Anyway, yeah. Okay, anytime, Hui, you want to answer this?
Okay, so there's a question on the timeline for Yoma to reach the target price. Our target prices are usually for a year, and then barring any like a second wave of COVID hitting Myanmar and like a recovery of like the Myanmar's economy, we are looking at a 1 year timeline. And then there's another question on whether they are over diversified and will this affect them and the share price. So regarding that, right, we actually applied a conglomerate discount of 20% in view of the diversified nature of Yoma. And then maybe just to add some color, Yoma is actually looking at increasing like the revenue pie for financial services as well as maintain that of the property sector. Whereas for the Yoma F&B and the Yoma Motors, they are actually looking at maybe not say downscaling it, but then they will focus more on property and financial services moving forward. So I guess with a bigger focus on certain aspects of their business lines, they will probably be more focused from now on.
Is Viren online? Okay, we just move on to the your views on Suntec. Natalie, you got anything?
Any views on Suntec? Actually, we don't really follow Suntec very closely, so I cannot really comment much about Suntec. So I guess that the retail portion of the Suntec REIT will likely be more stable. As you know, the commercial tenants are less affected. However, I think for the retail side, it will do quite badly because first of all, it is a tourist kind of attraction. Not to mention, there's also a component of it that is a beneficiary of MICE events, and also because it's surrounded by so many offices, which I believe that actually a lot of officers will be employing telecommuting for the rest of the year, or at least a large portion of their workforce will be telecommuting. So I think that will depress the F&B sales, etc. for the retail malls, for Suntec retail for the rest of the year basically. In terms of valuation, I cannot really comment much because we don't follow them that closely. We have another question for Paul on the impact of CCT price if the merger with CMT doesn't go through.
Oh, sorry, for CCT, I don't have the ratios for that. Do you have the I don't have that. I need to get back to you on that. If you send us an email, we'll try to answer that because I need to see how the ratios work for. But the impact won't be as bad as the Sembcorp industry. I don't have the numbers, sorry, so I don't want to kind of frivolously kind of answer your question if I don't have the numbers. So you send me an email, we'll try to get back to you. There was another question, sorry, I go back up. Sorry, I attended the SBS, I presume, SBS AGM online. They said they are not affected by the rail, but affected on bus service because the footing of expense. I think it's the other way around, really. Okay. One thing to note, okay, as analysts, when we cover this comfort, and they will never give you details of the contract of the rail or the bus. But I still think but very likely it's the other way around. But let me just double check with them again. But I'm pretty sure it is the other way around because rail is always passenger traffic that the volumes that are affected, and bus services is not. That is confirmed. But I'm not sure. Maybe it's the other way around. But let me just double check with them again, and I will try to come back. And especially when we are having our strategy meeting, I will just need to confirm that again. But yeah, but I need to get back to you again. But I'm pretty sure that way. But again, we don't want to make any comment until we double check this for you. Okay, I'll move on. For SCI shareholders, can you confirm what is the cost for owning the SMM shares? Okay, I actually even asked that management when they had the briefing. There is really no so-called a cost. I think what you can do is just do what is the value to you, which is like a 4.27 SMM shares times the theoretical extra price, which is times 25 cents, which is or maybe right now the share price dropped maybe 24. That I think you can use that as a cost for you. There's no real concept as like actual cost, like because you didn't really pay for it. It is your own shares. Of course, you can do some NTA thing You can even do because they're 1.5 billion, then they merge, but without going so theoretical about it, I think you can just use 4.27 times the X rights price of 25 cents. Because once it goes, as you know, once it goes X rights, they will drop to the theoretical X rights price of 25 cents. So you can, and then you can use that. Yeah, I hope that helps answer that. With the three bank share price dropping, is there any reason?
Okay, I think there's a question on the three banks share prices dropping, and I think today you'll be also kind of the trend. I think there was a question significantly asking about specifically why UOB dropped more than the others today. Yeah, I think generally when the bank shares actually picked up faster than the STI in general when we entered the when we reopened for the phase one. However, I think basically when that was quite personally, I felt that it was quite a bullish run without concern over the credit cost that might be rising from the whole impact of COVID-19. As we know, the impact felt by them in the credit cost itself will only start to be felt after all the debt moratorium ends. So they can't really, even they themselves will find it quite hard to discern how much the credit cost will rise in the near term. Of course, you have some, especially for those who defer their debt. So those that can continue paying, of course, they won't see any issues with it. But with so many people trying to defer their loan repayment until after the debt moratorium ends, which will only show up at the end of this year after September and after 2021, the second part. So I think generally that was too optimistic that once the economy just went back into normal, that these concerns for the credit cost will be underwritten away. So right now, I think generally it just dropped back down to meet market expectations of how the whole credit cost will be a concern in the near term, or over the next 1 to 2 years. So generally, I think most of the analysts, they were already kind of forecasting the increase in credit costs, and all the banks were already providing such a guidance ahead. So I think generally the bank's valuation right now is quite appropriate. I mean, if you're looking to enter the banks now, I think it is providing quite a value for a dividend yielding stock. Not to try to speculate or anything like that, but it is quite attractive with all the banks yield at about 5 to 6% right now.
Okay, let's move on. Natalie, can you answer this one also? Is it better to get the REITs or the sponsor themselves? Is the dividend yield that much difference in the capital then?
Actually, I believe that all the yields for the REITs, right, are generally higher, about 4.5 to anywhere around. If you look at Escort, currently the yield is around almost 6.7%. So I think yield, first of all, is different. The yield for the REITs will definitely be higher. Yield for CapitaLand, for example, is in the low 3%. However, I think in terms of ROE, the CapitaLand's ROE is 10%. So I think at the end of the day, right, they are not really similar. Definitely, if you buy CapitaLand, you have a exposure to the REITs as well, but it is different because it is the results from CapitaLand has in it some development kind of revenues, as well as the revenues from their platform, the investment platform, and Escort Limited as a accommodation manager. Yeah, so whenever you buy a developer, is the results that you're getting is actually mixed. So it's a bit different. For yield play, definitely you should go for the REIT itself. I hope that answers your question. How would recession affect S-REITs apart from what you have presented? So I'm assuming that for recessionary kind of environment, the interest rates will continue to remain low. Of course, for portfolio-wise, all the REITs with more high unemployment rate, probably we're expecting some retrenchment, etc. I think that for the office side, definitely we expect, or rather office as well as retail, we might actually expect increase in vacancy rates because of weaker consumer spending, etc. Higher unemployment. But one thing that you have to take note of is that for these REITs, they actually do have the leases are actually secured by contracts, so they are locked in, and you know, they have a natural schedule of expiry. Of course, this excludes cases where the tenant is under liquidation, etc. But in general, one thing that we have to fall back on is that actually that the leases are locked in. So I'll take another question on what's the difference between accumulate and buy. So actually accumulate and buy, basically it's just varying degrees of conviction, or rather varying degrees of returns, so to speak. So strictly speaking, an accumulate is anything between about 0 to 10%, if I'm not wrong, and it's 0 to 15%, and anything above 15% in terms of total return, meaning capital appreciation plus dividend yield, we call it as a buy, or actually I think it's above 20%. So basically it's just varying degrees of return and conviction. So I hope this answers your question.
Yeah. Anyway, at the back of all our reports, we have the return system. So like Nestle mentioned, 5 to 20 is accumulate. Then anything above 20 that we think is considered buy. So all the reports we will put the definition if you want further reference.
Answer I'm sorry.
Oh no, go ahead, Baron. There was some. Yeah, we're just trying to clear all the questions. The DBS. Yeah, sorry. Thanks.
Okay. DBS. If you read my past report, I think on 2 weeks ago, I think I do a summarize. I did an update. So for DBS, is looking to test the support at $20.08. This level is actually a support turn resistance. Resistance turn support level. So as long as price still trend above this support level at $20.08, I think price is still having an upside. If should it break, then I think the price will revert back to the support at $17.14 around that level. So you have to see. So if there's any, like, if price, and do take note that price has actually formed a wedge-like pattern. So if there is a wedge-like pattern formed by today and is close to a strong bullish candle, and I think that tomorrow there might be an upside. Yeah. So it all boils down to how the market is going to close today. Thank you.
You think you can mention about? I'll give you some time. Sorry, on the CSE Global, if you can do a quick one.
CSE Global. Let me.
It's okay. We'll wait for you, Ben. I'll try to answer some. Sorry, this is an easy one. Any insights on Hoppa? So sorry, some really no idea. The problem with a lot of all these companies that they don't want to meet you, they don't want to tell you. So we can just read whatever is in the news, and we don't really have much insight. So that's why, sorry, we don't have anything on Hoppa, and they don't want to see anyone or talk to anybody. They should just go private, maybe. Yeah, okay, and next one. Based on what Paul has shared so far, it looks like it is a sure lose situation for long-term investors of Sembcorp Marine. Is there a way to reduce our losses before selling away the shares they are holding? I wouldn't say sure lose. I mean, this type of market, we don't dare to say sure of anything. But maybe if all price rebound, then I think maybe that would help. But I think from us, we just want to highlight the risk. Even I know the share price already dropped a lot, but we just wanted to highlight the risks that the price might correct even more. I think that's all we want to do. We don't dare to say that, oh, you sure lose from now. And it's like, we're not so clever. Okay, but we just wanted to highlight to you there's a lot of risk of further downside. Is there any way? I guess, like we mentioned, the best is just to switch it out and buy into Sembcorp Industries. I think that would be the again, if you have it, I mean, if you don't have it, then maybe you don't even have to touch it. But if you still have it, I guess that would be the better option, because then technically you're actually getting very cheap access to Sembcorp Industries shares. I think that's the best I know how to answer. I hope it helps. Thanks.
There's a question just now on CSE Global. So I pull out the chart. There's not much price movement actually, so it's hard to read the technical action on it. But then I went to the weekly chart. So the weekly chart actually shows that the price is on a very long-term downtrend since 2007. So currently we are kind of like a rectangle rangy kind of like price. So price did indeed rebound from 0.014 cents. Okay. But price lacked the momentum to push price beyond 0.02 means aka 20 cents. So I think that price may hover, may retest the low at 0.12. Okay, so it's 0.012. Okay, so I hope that answers your question. And then there's one more question on SPH. So SPH, if you read my report previously, okay, so I initiated a sell call on that. Although there's a rebound today, as long as price still maintain below the resistance at 1.38, okay, the resistance at 1.38, I think price is going to hover at the lower end of the stock, and should it break 1.38, okay, I think the next level at 1.45 is also going to be tested. So given the momentum of the stock, I don't think that that SPH will revive the bull run in the shorter term. At most, at most, it might go into a range between 1.29 to 1.4546, that region. I hope that answers your question on SPH. Thank you.
Hi, there's a question on Yoma's long-term debt, ROE, ROA, and cash holding. So in terms of long-term debt, right, as in like as rightly pointed out, like the long-term debt is about 259 million, and then like the income coming in is only about 34, 7.6 times of what it is. But then from what I know, I think Yoma is actually actively trying to pay down his debt, and then especially with like the new investment from Ayala Corporation, some of its proceeds will actually go into the paying down of the debt. So we expect this amount to be lowered going forward. And then with regards to the ROE and ROA being low, this is because like the current environment of Myanmar, as in with COVID and I guess like for now they are not in the near term. We will see headwinds that will impact Yoma's earnings. So in the near term, as in that is actually expected to be the case. But then as mentioned, like in the long term, we are actually looking at the growth of Myanmar to actually accelerate or help to bring the share price upwards. Yeah. Their current cash holdings are about 30,000 million, I think. Hang on. Their current cash holdings, sorry, $30 million. Then there's another question also regarding Yoma's growth being dependent on domestic demand. So the growth forecast for Myanmar is expected to be around 2 to 3% for this coming year. Yeah. For the next few years, right, it's expected to be in a range of 4 to 6% upon recovery from COVID.
Natalie, you want to do the escort? You just spoke to them on the REIT inclusion.
For the for any inclusion into the index, especially one so prominent such as the REIT Developed Index, we actually expect, first of all, for liquidity to improve, and due to index funds actually buying in more prominence, so liquidity to improve. Also, I think this buying into the index by index funds will actually increase it will cause the share to sort of trade at a premium lah. So I think on the day of the announcement, the share price actually popped about 7%, if I'm not wrong. So I guess that's the main benefits of being in the REIT or such a prominent index. Just basically more wealth. So it enables price discovery in a way.
Okay, I think usually what happens is once they announce, then the whole world, not you and me, everyone in the street will just try to run a REIT. So once it happens, so everybody wants to buy, because as you know, today is the inclusion of REIT. So by Friday closing, all the passive funds have to accumulate their positions into REIT. So on Friday, everyone front run when they announce, then you just wait until like tomorrow, like on Friday. That's why you saw a big spike in the volume, because at the closing, all the funds, once it's already included today, then all these passive funds have to have the position in escort REIT. So you can say that the next few days on paper there should be some weakness, because everyone has been buying out the share because they know someone has to has to, once they include, they have to buy. There's a buyer, captive buyer of Escort REIT the day before inclusion, because at closing, once you by today, you should already have Escort REIT if you're a passive fund, because you do not want to be misaligned with the underlying index. So in a nutshell, I think there could be some selling in the next few days, because all those the buying were just trying to get into NAREIT. Yeah, that's why you saw the volume spike up tremendously yesterday because of this inclusion. But in terms of operational, we did ask them, it doesn't really make any change, no difference operationally. Okay, do you think the market has overshot? I don't. I think last few days, yes, but maybe by now, no. We just think that the liquidity conditions is just very conducive for the market. I mean, how to buy a bond now? I mean, it's like 1%. It's more like you mentioned, it's more of like a hedge. So we think that, but it will be different. I mean, it will be a gradual improvement in the share price. I don't think, because there isn't, from now till then, I don't think there's any really major catalyst unless we see some really strong economic data. Again, this is very short-term view. So most times I'm wrong anyway. So, but anyway, but directionally we are still positive, because we think that the monetary conditions is very supportive. I think where else can you do? Where else can the money go now? You can't buy bonds. Yeah, so that's why we think. It doesn't mean all the support is for the financial markets. It's not for the real economy that we've seen from the Fed. Any thoughts on SPH based on current share price? I think Biren, if you can. Okay, another question for REITs. Do you think? Yeah, sorry, go ahead. Yeah.
The SPH I've answered already. So earlier.
Sorry.
So
sorry.
Because I didn't clear away the question. So I'll answer next one on the UOB. So UOB actually compared to EBS, UOB actually has a sell down today. So I think that if there's a persistent sell down today, I think it might test $19.33 to $18.79. That region will be a potential rebound zone. Okay. So if it doesn't rebound from there, then we'll see that price might continue to edge lower to $17.81. Whatever the reason, I think Wee Guang will answer your queries on banking fundamentals as well. So my side, I think I'm looking at how the momentum is and how the short-term price movement are. Okay, so I hope that answers your question. And just now there's a question on STI I posted on to Nancy already. So just to add on that, I forgot to add on is that STI is, although it's hovering at the support zone, but there is still a chance that there's a higher probability that it might break below the support zone and then trend lower. So we have to look at Wednesday how the price is going to be at. Okay, I hope that answers your question. Thank you.
For the question on for the question on the REITs, do you think it's too fast to look at REITs, because now we cannot gauge how many shops will close and how long the opening remains so cold? I assume you're referring to retail REITs. Actually, in all our own projections, we will the analysts will have actually incorporated some sort of assumption based on our view on how much the vacancy will go up by, etc., and how much sales will dip by. I think one thing to note is that regardless of how empty or the shops are currently, retail shops, etc., the thing to note is that the turnover portion of rent actually only contributes less than 5% of the REITs revenue. So a lot of it largely is based on fixed rent lah. And then another thing is, as mentioned, we did already incorporate some sort of vacancy rate to go up in the near term because of this uncertainty and businesses letting their leases expire. So whether or not it's too early to look at it, we look at it from a fundamental point of view. It is difficult to time the market, I think. Also, so from a fundamental point of view, it still looks relatively attractive.
Yeah, I think the question we always grapple with is when do you buy? Do you want to buy when everything is okay? Then the price would have reflected. So for us, we are just taking a position that I mean, forget about 2020. I know the year is already gone. I mean, don't expect any good dividends. But for us, we are just our view is just that things will continue to improve from the current levels. There will be some closures. I think you won't see no signboard announced they're going to close their Clarke Quay. So those tourist ones will be affected the most. The small shops will be affected the most. But we still think it will still be a resilient sector, especially the suburban malls. So obviously you can always wait until things are all okay. Then, but you're not sure whether the price would have already more or less recovered by then. So with that, our view is just that things will continue to improve. I think that's the general sense. Yeah, it's hard to pinpoint the exact time, but we just take the view that the trajectory is improving. Okay. Okay. We still got a few more. I try to answer. Then some a bit out of my league. Some of them. Okay. Would emerging economies exposure in companies be more risky with wave 2 catching on? I think some of them not even wave 2. I think some of them are still being hurt by wave 1. Like obviously the notable one is Brazil. I think they're. I'm not sure, no, really, because like if you look at something like in Indonesia. What worries me also, apart from the wave 2, is the ability of any government to support emerging markets. The government may not have that much resources to kind of support their own economies. So that's why emerging economies are a bit more hesitant, because if they go and pump prime, what was the impact on their currencies? So that's my only view. That's the best I can do, because I don't have the data. So I try not to answer your questions, but apart from this wave 2 risk, because of the ability of the health facilities, my other worry is the ability to support the economy. So it's not like Singapore, we have so much additional resources in that sense. Yeah, so sorry, I'm not a really comprehensive answer, but that's the best. Yeah. And Natalie, can you answer the property one first? I'm trying to get data on the Jardine Cycle and Carriage.
Okay, I'll take one question about can we discuss REITs, data center REITs like Capital DC and Maple Industrial? It seems like it's never coming down. I think Capital DC already has started to show some signs of coming down. I think we won't release a report on them. I'm not sure, but anyway, basically, the yield for Capital DC is around the sub 3%, 3.9, 3.7%, and it's considered quite low compared to all the other REITs. I believe that they are actually testing the price, the highs of the price, and it has corrected a little bit in the last 2-3 weeks. So that is for Capital DC. While we take note that actually overseas data center REITs are actually trading around 1.9% to around 4.4%. So it could be that the Singapore market is actually also trying to price these data center REITs in such a manner or with such a yield. Yeah. For Maple Industrial, actually, I think only about 20%, or probably slightly less than that, is in data centers. So for right now, where we are in this property cycle and in this economy, the industrial sector is actually looking at like one of the more resilient kind of asset classes. So that's probably why the reason for the industrial REITs to continue to trade at such elevated prices moving forward.
Move on. Okay, can you comment on Jardine Cycle? Yeah, sorry, I think this was a question the previous. Okay, I'm just looking at auto sales. As you know, Jardine Cycle and Carriage you're just buying Astra. It's an indirect way of buying Astra International. So I'm just looking at the auto sales in Indonesia. So they actually just fell by 95%. So obviously there'll be some recovery, but I think I will probably it's just looking a bit bleak for Jardine at this point in time, considering the weakness in auto sales. And again, this is just a discretionary item. So I'm just answering very top down answer as best I can. I'm just showing you the auto sales is just down 95. So it will take some time for auto sales in Indonesia to recover. As you know, Jardine owns Astra International, and Astra International, most of it is auto sales and especially Toyota, and also auto financing. Yeah, sorry, I just hope it's the best I can do for now. Does Phillip cover Hong Kong stocks? Yeah, we do cover, and some of the reports are in our Hong Kong stocks B&B. Any advice on Cromwell REIT? Natalie, you want to try?
For Cromwell, actually, I don't really have much comments for Cromwell. Maybe Jie Hui has some comments.
Yeah, anyway, for us, I think we did have a call with Cromwell, and I think for me at least, I'm quite positive on because the yield is pretty attractive. If I'm not mistaken, correct me if I'm wrong, probably like 6 to 8% for euro, and then you can margin finance it. I mean, I'm not asking you to do it, but you can also still margin finance it. I think Cromwell is attractive from my point of view, and it's all office and has been relatively stable in terms of the kind of the rentals that they've been having. And there haven't been many problematic tenants. There's been just a handful. So I'm quite positive actually just on all the overseas REITs. Because the yields are just so much more attractive, and these are US dollar and euro assets. Just a general general comment I can give for you. Yeah. Okay. The other one. Is it advisable to trade Hong Kong stocks due to the FX? I can't comment. Sorry, I can't. We don't cover Hong Kong, so I have to let go of this question. The other question, is there a ETF that represents major risks like STI? Okay, this one is an easy one. Finally, I get an easy question. Philips we have a Lion Phillip ETF, so that is the ETF that replicates all the REITs. You can just go. You can just go on the SGX. You can just type Lion space Phillip S-REIT ETF. And there used to be a withholding tax, and then the government removed this. So probably this is a pretty good vehicle if you want to get exposure into all the REITs. And if you're like me, lazy to pick stocks, then you can just buy this STI ETF. Or if you don't think you're so clever to pick the right stock, then you just buy an ETF. Okay. So Viren, can you repeat? There was someone you mentioned resistance and support. We'll take another 1-2 questions because I think we have to leave time for Viren's event at 1 p.m. Okay. Anyway, move on. What is your view on the logistic counters, Natalie? I think we just take this as the last question. Sorry. Yeah. So just been too many.
For the logistic counters, actually, I believe that we only have one pure play logistics, which is Mapletree Log. I think the comment from the industrial players is that definitely the demand for, or rather the volume of e-commerce and demand for logistics assets will increase, but not more as like a pass-through kind of port like asset, not really for storage. So I think while the e-commerce will increase, right, the amount or demand for warehouses for storage purposes might not actually reflect this. Yeah, so that's about all that I can comment on logistic counters, because we don't really cover.
Yeah, I think amongst all the sectors, correct me if I'm wrong, I think logistics or warehouse has been the one that has probably if I could say a beneficiary of this whole situation. They are probably among all these sectors, they're the one who benefit the most, I guess, because the whole supply chain has changed. Everyone needs to stock up more. Everyone needs to get closer, and they cannot only have a warehouse in China. You need to have one in the US because all this disruption. So amongst the various sectors, they probably the ones that benefit, apart from Capital DC, of course, the data centers. So they are also one of the that has been benefiting because the supply chain has kind of have been affected by this whole pandemic. There needs to be more warehouse space required. That's what they've been getting from the customers.
The support for UOB just now, I'll just do a last question, very fast one. The support of at $20.90 has been broken. So I think that price in the midterm might continue to test lower at $19.31 to $19.77. If this region should this region as a bit of rebound, I believe that in the midterm it will be very range bound. Alternatively, if the above mentioned support zone is broken, we can see that the price will go to test $17.89 in the next level. I hope that answers your question. Thank you. So I think we are done for now. So if any question, just drop us an email, and then we'll see you again 2 weeks later. Thank you very much.
For reference, the email to send to
just to add on, you can send your email to research@phillip.com.sg. Alternatively, you can go to Stock BNB website to find our to drop us an email to individual of us. Thank you.
Yeah, okay, because sometimes we can't answer all because we have to get data, we have to think about it before we try to answer, and not just give you some answer off the top of mind. Sometimes we have to try to think through all the answers before we give. So sorry, sometimes we can't really answer some of your questions because we try to give answers that's based on some data, something factual that we can support it, rather than just throw off some again frivolous opinion. So we hope you understand. Yeah, thanks everyone for listening. I hope to see you in 2 weeks time or in our strategy meeting. Thank you.